In 2002, a New York company named Fareportal decided that flying was not just about moving bodies from point A to point B. It was about a business model that, according to regulators, diverted funds that should have gone to the public treasury into private hands. Sam S. Jain, the founder and executive chairman, built a hybrid travel technology empire that operated both consumer brands like Cheaper and business-to-business platforms. The goal was scale, often achieved through complex corporate structures that regulators later found to be opaque. Cheaper promised cheap flights and last-minute deals. It was a noisy, visible front for a quieter, more lucrative back-end operation. The strategy was simple: sell tickets to the public while hiding profits from the state. To understand how this worked, you have to look at a specific line item in the corporate ledger. It was called management fees. On paper, it sounded like legitimate administrative overhead. In practice, it was a funnel. The destination of these fees was an entity named Magic Travel, LLC. This company had no employees. It had no office furniture. It had no HR department. It existed solely to hold the personal investments of Fareportal's owner. From 2007 to 2012, Fareportal and its affiliated companies paid approximately $145 million in management fees to Magic Travel. That is $145 million. For context, the entire New York State corporate tax system collects less than that in certain budget shortfalls. But this money never touched the state's books. The accounting logic was elegant in its simplicity. If you pay a management fee to a related party, it is an expense. Expenses reduce taxable income. If Magic Travel is not a taxable entity, then the income disappears. This, it turns out, was not how the Internal Revenue Service worked, or how New York state law functioned. The arrangement disguised what were effectively dividend payments as operational costs. The company avoided paying over $1 million in New York state corporate taxes during that 5-year window. You are about to hear a number. The number is real. It is in the settlement documents. The amount avoided was small compared to the fees paid, but it was the spark that burned the house down. The fatal misread was assuming that internal financial engineering was invisible to regulators. The team believed that because the structure was complex, it was secure. Complexity is not camouflage. It is a trail of breadcrumbs. The warning signs were there. Outside accountants explicitly warned Fareportal that these management fees could be classified as dividend payments. Dividends are not deductible. They are after-tax distributions of profit. The company ignored the warning. They continued to classify millions of dollars of taxable dividends as management fees paid to Magic Travel. This was not a small oversight. It was a systematic reclassification of revenue to minimize visible tax liabilities. The business model relied on the assumption that no one would look closely enough at the intercompany transfers. The scrutiny came from an unlikely source, a whistleblower. The investigation into Fareportal's tax scheme began after this individual filed a qui tam action under the New York False Claims Act. A qui tam action allows a private citizen to sue on behalf of the government. If the suit succeeds, the whistleblower gets a percentage of the recovery. It is a legal mechanism designed to incentivize insiders to betray their employers. The whistleblower did not care about corporate ethics. They cared about the payout, but their motivation aligned perfectly with the state's interest in recovering lost tax revenue. The case was led by Assistant Attorney General Susan Giacomo of the Taxpayer Protection Bureau. She saw a pattern that stretched back half a decade. The pattern was clear: revenue in, fees out, taxes zero. Fareportal tried to defend the structure. They argued that Magic Travel provided valuable management services. This is a sentence I never expected to write, but it was the core of their defense. The state argued that Magic Travel provided no services at all. It was a shell, a holding company with no employees and no function other than receiving checks from its owner's travel businesses. The contradiction was stark. How can a company with no employees provide management services? The answer, according to the state, is that they don't. They just hold cash. The legal battle forced a reckoning. Fareportal and its affiliated companies, including WK Travel Inc., Gen NY Inc., and Tripma Inc., faced the full weight of the tax code. New York Attorney General Letitia James secured a $4.5 million settlement from the group of companies. The settlement covered the failure to pay over $1 million in state corporate taxes. The math was simple. You took money that belonged to the public and you returned it with interest. But the settlement included a twist that satisfied everyone except Fareportal. Approximately $1 million of the $4.5 million paid by the company went directly to the whistleblower. $1 million for pointing out that a shell company was not a service provider. The reward was substantial, but it was also a public admission of guilt. This was not an isolated incident. Attorney General James had previously secured $2.6 million from Fareportal in an unrelated case involving deceptive use of dark pattern marketing practices. Dark patterns are UI designs that trick users into making decisions they did not intend to make. From misleading pricing to hidden fees, the company had a history of prioritizing conversion over compliance. The tax evasion case was the culmination of a decade of aggressive financial engineering. The company's complex corporate structuring resulted in minimized visible tax liabilities, a practice that eventually drew regulatory scrutiny. They believed they were innovators. They were building a sophisticated financial engine that turned flights into tax-free dividends. In reality, they were running a very expensive accounting experiment with the state's money. The collapse was not sudden, it was the result of a slow accumulation of liabilities that finally exceeded the company's ability to hide them. The whistleblower provided the key to the lock. Sam says, Jane had built a massive online travel agency empire. Make My Trip was the crown jewel, valued at billions. But Fareportal's domestic operations were built on a foundation of questionable accounting practices. The hybrid model allowed for flexible accounting. B2C brands like Cheaper drove traffic. B2B platforms handled the back end. The opacity of the B2B side allowed profits to vanish into magic travel. The state alleged that this was not flexibility, it was evasion. The settlement described a scheme where taxable income was systematically redirected to non-taxable entities. The financial metric that mattered most was the $1 million in taxes avoided. It seems small, but in the world of corporate tax law, it is a smoking gun. The company's defense crumbled under the weight of the ledger. There were no complex legal arguments to save them. The facts were plain: fees paid, taxes unpaid, shell company employed. The settlement forced a change in how Fareportal viewed its own operations. They had to acknowledge that the state saw through the structure. The blindness was no longer a feature, it was a liability. Following the settlement, Fareportal continued to expand. They introduced Ollie, an AI-powered travel assistant. They strengthened partnerships with Sabre for analytics capabilities. Technology does not erase past liabilities. The company laid off approximately 200 employees from its Gurugram and Pune offices amid the coronavirus pandemic. The pandemic disrupted travel, but it did not disrupt the regulatory scrutiny. The tax evasion matter had already been resolved. The check was signed. The money was paid. The whistleblower received their share, $1 million for exposing a decade of tax evasion. The reward was a testament to the power of the qui tam statute. Sam S.J. remains a figure in the travel industry. His legacy is complex. He built a global brand, but he also built a case study in corporate tax avoidance. The Fareportal tax evasion matter was led by Assistant Attorney General Susan Jacquemote. She closed the case, but she left behind a warning to other executives. The final image is a $4.5 million settlement check, signed over with $1 million of it going directly to the whistleblower who exposed the scheme. If a business model relies on opacity to survive, is it innovation or just sophisticated evasion?